Hello there and welcome to the Core Finance Show where I'm joined by Marc Otswald, who's a strategist at ADM Investor Services. How are you today, Marc?
I'm very well, thank you.
I take it you're on the edge of your seat waiting for the US GDP numbers?
Well, yes, particularly in light of the European GDP numbers that we've had this morning. France was sort of at the back of the pack, but still solid 0.5. We've had Austria and Spain both putting in a 0.9, and then we've got Sweden, where monetary policy is super loose, posting a 1.7% quarter-on-quarter growth, 4% year-on-year, and yet the Swedish Riksbank still thinks it needs to keep extreme levels of monetary accommodation. Obviously, they're obviously unimpressed by that sort of a growth rate. US,
it's almost like Chinese performance there, isn't it?
Yes, it's getting on for that. I think that the key thing with the GDP in the US this afternoon is probably the risks are going to be the upside. There have been some small tweaks up. The consensus looks for 2.7%. If you look at the trade data that we had yesterday, it looks like we're probably going to have a net positive contribution from trade, where most people were assuming it was going to deduct something in the range of 0.2 to 0.3. It may can add 0.1 to 0.2. Wild cards in it, inventories, we always never have enough data to second guess what's going to happen. That it's assumed that they're going to make a positive contribution. And the other one, which I'm not 100% convinced about in terms of the consensus forecast, is the consensus is looking for business investment, particularly in structures, to be at a faster pace than the 7.8% that we saw in Q1, which looks a little bit ambitious to me, particularly given the uncertainties that Mr. Trump has unleashed.
I can't think of any of them. Let's go on to the official headlines today. Market movers, euro dollar breaking $1.17. And Barclays, we were discussing this offline. As a customer of Barclays, you're paying for their latest £1.2 billion write-down by some method.
Yes. All the fines and the litigation that people keep on suffering seems to never stop with the UK banking sector. It's really quite sad. At some stage, I guess a line is going to have to be drawn under it. However, we're still in this situation where a lot of people feel very, very uncomfortable that really no one has paid the price, the people who are in charge of these big banks, whether it's in the US, whether it's the UK or Europe, no one's really paid a serious penalty or seen a conviction for the mismanagement that went on at the time.
Yes, but it was stupidity rather than anything criminal. I think that's the main thing there.
Allegedly.
Allegedly. The other point there is that, rather than banking with Barclays, wouldn't it be better to, because if you don't want to pay or help pay for the 1.2 billion write-down, wouldn't it be better to bank at a challenger bank or one of these newfangled type of apps?
Challenger banks are certainly a possibility, and I think that there has to be a recognition that with the banking sector, pretty much the developed world over, mired in ancient technology, which it desperately needs to upgrade, and these new young Turks of the fintech sector coming through. Banking may not be dead, but some of the banks probably are on the way to a fairly slow death.
Actually, at that point, I was trying to stick the knife into the challenger banks, because I'm sure they keep the same margins as the old banks, but don't actually have to pay these legacy losses. So they must be having a very good time.
Well, they should be, yes. Yeah.
Okay. So don't get mad, get even. Buy some shares in those challenger banks. Next up, we've got the AIM company to watch, where again margins seem to be quite healthy there. It's one of those things that you hear about, low wage economy and consumers being up to the eyeballs in debt and everything else. But companies like Patisserie Valerie and others, you're going there, you're paying £5 for a croissant or something like that. With the small ticket items, people don't seem to notice. They just click on their contactless card and away they go.
Well, that's probably one of the dangers of contactless cards, that a lot of people don't really quite understand just how much money they're paying out. I think the risk here with Patisserie Valerie is you wouldn't want to see a situation where the tourist footfall, particularly in places like London, starts to fall off, because the UK consumer is clearly getting more and more encumbered by high levels of debt and obviously low levels of, well, negative real wages. So for them to carry on with this sort of luxury brand, one might say, in the food, is going to be something of a challenge. So growing the market will be dependent on the tourists keeping on coming to the UK.
Okay, let's go on to the pound, which has basically been the same all week. It did sort of try and flirt with the higher levels, 131.50, but hasn't made the big break just yet.
Not just yet, and I think it's really quite difficult to make the case for sterling going that much higher, unless you actually think that on the back of the rather weak UK GDP numbers and the fall in inflation, that the Bank of England's going to start to tighten policy, which seems to be very, very far away, particularly at a point in time where we are realistically assuming that the ECB is going to start to ease down. And I still think people are underestimating that the Fed. I think a lot of people are very sceptical about the Fed's own outlook. They don't believe that they're going to achieve the inflation level that they want, and therefore they will have to cease and desist from rate hiking, but I'm not quite sure that's right.
Okay, let's see what we have. Broker recommendations. I was trying to work out, make a market, and how many seconds it took Berenberg to hike their old target in Fever Tree drinks from 1850 to 2400. I was looking at less than 10 seconds, but any call on this one other? Well, I suppose it's related to the Patisserie Valerie situation, that you've got this high margin drink, obviously not quite as not as healthy as maybe some, but very fashionable indeed. Valuation PE of 66 at the moment, historic PE there. Can anything go wrong here?
Well, I mean, I think the problem here is we've seen over the years a lot of people, say, replacing some of the traditional old brands which used to completely dominate that market, like Schweppes, like Coca-Cola. And one always has to question, how long is this fad going to last? Obviously, a well-run company can keep its, presence in pubs and bars for quite some time, but suddenly there's a new fad which comes along, and there's a new brand, and people suddenly switch, and so there's vulnerability there.
But I think that it seems to me that the valuation here is based really on the distribution network that Fever Tree has. It's actually managed to invade all the outlets very, very quickly. So whoever, it's
well managed.
Yes, exactly. So
no
that's almost more important than the drink. I mean, they could go into any area now, whether it was donuts or this or that. They've got the outlets, they've got the distribution to sell.
Yes, absolutely. And as long as they keep on innovating in terms of the actual brands that they've got, they probably can keep up there. But there's always going to be some new challenger coming along. They came from pretty much nowhere.
Ostwald whiskey or something like that. A good ring to it. Core number 2022, or the end of never, maybe. That's apparently the time when we have to come up with a Brexit deal, but there doesn't seem to be a necessity on that in terms of, or a will to get that.
Yeah, I think the problem with any numbers which are thrown around in terms of when would a transitional deal after 29 end is pretty much pie in the sky at the moment, because there doesn't actually at the moment seem to be much rapprochement between London and Brussels about, for instance, the financial settlement. So we're not even going to have a discussion, as Mr. Barnier said, about a trade deal until something's sorted out on that front, and that both sides seem to be pretty much entrenched.
It's cheaper to not pay than it would be than any benefit you get from the deal. 100 billion. I mean, it'd take a long time to do trade deals worth 100 billion, but I'd rather just not pay.
If one doesn't pay, then you're basically in a situation where you're not only setting a bad example with the rest of the EU, but the rest of the world would look poorly on it from the fact that the UK is basically reneged with a core trading partner.
I can get over it. All right, well, let's see what's up later today. US GDP, personal consumption, the Baker Hughes rig count, and then at the end of the day, the Fed's Kashkari. Is the Fed's Kashkari going to deliver anything?
Well, Kashkari is interesting simply from the fact that he's the first Fed speaker after the FOMC meeting. He's also interesting for the fact that he is the dove on the committee, and he actually is in line with the market in terms of not believing that the Fed's actually going to be able to achieve its inflation target in the near term. So he doesn't want the Fed to tighten too much further. However, interestingly enough, he is actually still in favour of balance sheet reduction, which I think is a good reminder that actually there's two different things in operation here. In terms of rate hiking, the Fed will be looking at the inflation data and to a lesser extent the unemployment data. In terms of balance sheet reduction, that's going to be far more contingent on the GDP numbers, and I'm not sure that that's quite appreciated by quite a lot of people in financial markets, because it is quite a divergent set of parameters for the two.
Thank you to Marc Otswald, strategist, ADM Investor Services, and thank you to BEAUFORT Securities for sponsoring today's Core Finance show.